In 2008, the stock market didn't just go down, it collapsed. The S&P 500 lost more than half its value, major banks failed, and millions of people around the world were affected. Jobs disappeared, homes were lost, and entire retirement plans were wiped out. At the time, it didn't feel like a normal downturn. It felt like the system itself was breaking. And now, years later, with markets once again reaching high levels, many people are asking the same question. What happens if the market crashes again? And would it look like 2008? To understand what could happen today, we first need to understand what actually happened back then. The 2008 financial crisis wasn't just a stock market event. It started deep inside the housing market. Banks were issuing mortgages to borrowers who couldn't afford them, often with little to no verification. These loans were then bundled together into complex financial products and sold across the global financial system. For a while, everything seemed fine because housing prices kept rising. But when those prices stopped going up and eventually started falling, the entire structure began to collapse. As homeowners defaulted on their loans, banks started taking losses. Those losses spread quickly because many institutions were connected through these mortgage-backed securities. Confidence disappeared almost overnight. Banks stopped trusting each other, lending froze, and the financial system began to seize up. Stock markets reacted violently. Panic selling took over, and the S&P 500 fell by more than 50% from its peak. For everyday investors, this wasn't just a number on a screen. It was a life-changing event. Now compare that to today. The situation is very different in some ways, but there are still important risks to understand. Unlike 2008, the banking system today is generally more regulated. Lending standards are tighter, and banks are required to hold more capital to absorb losses. The specific problem that caused the 2008 crisis, risky mortgage lending, is not as widespread today. That reduces the chance of the exact same type of collapse happening again. However, that doesn't mean the market is risk-free. The risks today are different. Instead of housing-driven leverage, we are dealing with factors like higher interest rates, elevated valuations in certain sectors, and global economic uncertainty. In recent years, interest rates have risen significantly compared to the near zero levels that existed for a long time. Higher rates affect everything, from borrowing costs to business investment to consumer spending. When money becomes more expensive, growth can slow down, and that can put pressure on stock prices. Another key difference today is market concentration. A large portion of recent market gains has been driven by a relatively small group of large companies, particularly in technology and innovation sectors. While these companies are strong, this concentration creates vulnerability. If those few leaders start to decline, the overall market can be pulled down with them. This is different from 2008, where the problem was widespread across the financial system. Today, the risk may be more concentrated, but still significant. So what would actually happen if the market crashed today? The early stages would likely look similar to past downturns. Prices would begin to fall, possibly triggered by economic data, policy changes, or unexpected events. At first, the decline might seem manageable, but as losses increase, fear would start to spread. Investors would begin selling to protect their portfolios, and that selling could accelerate the decline. Markets don't just fall because of data, they fall because of reactions. However, one major difference compared to 2008 is how quickly policymakers can respond. During the COVID-19 crash in 2020, governments and central banks acted rapidly by lowering interest rates and injecting liquidity into the system. That response helped stabilize markets and led to a faster recovery than many expected. Today, that same playbook exists, but it comes with limitations. Because interest rates are already higher, there may be less room to cut them aggressively without risking inflation. This makes the situation more complex. For investors, the experience of a crash today would still feel very real. Portfolio values would decline, sometimes quickly. News headlines would turn negative and uncertainty would increase. But just like in 2008 and 2020, the key factor would not be the drop itself. It would be how investors respond to it. Those who panic and sell during the downturn would lock in their losses. Those who stay invested would give themselves the opportunity to recover when markets eventually stabilize. History shows that markets have always recovered, even after severe downturns. After the 2008 crash, it took several years, but the market eventually reached new highs. After the 2020 crash, the recovery happened even faster. These recoveries are not guaranteed to happen quickly every time, but the long-term trend has been upward. This is why long-term investors focus less on short-term timing and more on consistency. One of the most important lessons from 2008 is that the biggest losses often come from emotional decisions. Many investors sold near the bottom because they couldn't handle the uncertainty. Others waited too long to re-enter the market, missing the early stages of recovery. The result was not just a temporary loss, it became a permanent one. This pattern repeats itself in almost every downturn. Smart investors approach crashes differently. They understand that volatility is part of the system, not a failure of it. Instead of trying to predict exactly when a crash will happen, they build strategies that can handle uncertainty. This includes staying diversified, maintaining a long-term perspective, and in some cases, keeping some cash available to take advantage of lower prices. When others are reacting emotionally, they are thinking strategically. So if the market crashes today, the experience may feel similar to 2008 in terms of fear and uncertainty, but the underlying causes and responses could be different. The system is not the same as it was back then, and neither are the risks. But one thing has remained consistent. Markets move in cycles. They rise, they fall, and they recover over time. The real takeaway is not to predict whether a crash will happen, but to be prepared for the possibility that it will. Preparation means understanding your investments, knowing your time horizon, and having a plan that doesn't depend on perfect timing. Because when markets are calm, it's easy to feel confident. But when markets are falling, that's when discipline matters most. In the end, a market crash is not just a financial event, it's a test of behavior. The difference between investors who succeed and those who struggle is not whether they experience downturns, but how they respond to them. Because while crashes are temporary, the decisions you make during them can have lasting effects. If you made it this far, give it a like and subscribe to the channel. Thanks for watching. Disclaimer. This video is for educational purposes only and is not financial advice. Always do your own research before making financial decisions.